In my view, what China needs to do is to basically pump a lot of liquidity into its economy. China's the only major bond market where yields are dropping. Effectively, they're suffering debt deflation. China just can't go down this path. I mean, you look at the history of debt deflations. I mean, it really does kill economies. And so they've got to get out of that trap as soon as they can, which basically means devaluing the yuan domestically. Now, I'm making that distinction between external and internal, but they've got to basically print money internally. And what that means is if they do that, the gold price goes up, because gold is a fantastic monetary inflation hedge for domestic Chinese. That's what they love.
My belief is, and again, I don't invest for what could or should happen a year from now. You can't be that way. You can't. You know, gold is someday going to go $10,000 an ounce, but there's sometimes I don't have any of it, and sometimes I have 20% of it.
Global financial markets stand on the edge of a major structural shift as escalating sovereign debt and persistent inflationary pressures strain central bank policy worldwide. Michael Pento, founder of Pento Portfolio Strategies, alongside Michael Howell, managing director at CrossBorder Capital, cautioned that an impending liquidity bottleneck will soon trigger widespread revaluations across global risk assets. With government debt service obligations reaching historic record highs, monetary authorities face an inescapable choice between debt monetization and a severe credit crunch. Projections indicate financial models forecast a sharp liquidity squeeze unfolding over the coming quarters, driving corrections across overvalued equities, high-yield corporate bonds, and commercial real estate. Furthermore, central banks are predicted to be forced into aggressive balance sheet expansions, generating elevated market volatility. Navigating this environment requires disciplined wealth preservation strategies, defensive positioning, and capital reallocation into resilient assets before systemic market stress intensifies. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Well, I mean, my view would be is if and when, and I think it's a question of when the Fed begins to tighten. I think they're going to have to, because the bond market, is more or less screaming that. If you look at the spread between repo and 2-year treasury notes, I mean, it's basically signaling, and it's pretty much correct. And the actual fact, as an aside, I did an AI back test, and it said, 85% of the time, the 2-year is right on predicting the future course of Fed funds rate. And that would say that you're looking at certainly a couple of hikes coming down the road. So as soon as the Fed starts to engage that, my view would be that the dollar starts to pick up. And I think that, that inevitably, if the Fed tightens, the dollar goes up. I think we're going to see it again. Well, I think the key point about the current cycle is that the cycle in the West, led by the Fed, is basically beginning to roll over, as I said. But if you look at the Chinese cycle, it looks like it's the opposite phase of the cycle. It's beginning to pick up. And one of the things that in my view, what China needs to do is to basically pump a lot of liquidity into its economy. China's the only major bond market where yields are dropping. Effectively, they're suffering debt deflation. China just can't go down this path. I mean, you look at the history of debt deflations. I mean, it really does kill economies. And so they've got to get out of that trap as soon as they can, which basically means devaluing the yuan domestically. Now, I'm making that distinction between external and internal, but they've got to basically print money internally. And what that means is if they do that, the gold price goes up, because gold is a fantastic monetary inflation hedge for domestic Chinese. That's what they love. Now, the fact is that we saw gold going up until we didn't. And basically since around March or thereabouts, we've seen the gold market begin to come off quite noticeably. Now, interestingly enough, if you look at the detail of People's Bank of China liquidity, they turned the money tap off on March the 2nd of this year. And they only restarted it again basically the day of the MOU. Now, if you look at that timeline, in other words, when Iran tensions began, the Chinese cooled their economy. And when it looked as if the Iran tensions were over, they restarted growth again. And I think China has basically deliberately tried to cool the economy, so import demands for crude are de minimis. And they seem to have achieved that. Now what they're doing is they seem to be restarting, and I would imagine that what you've got to see in the next few weeks and months is the gold market picking up. That if you look at what governments are doing, governments are basically addressing every problem with more spending. and you look at what's happening, just look at the recent example of the Iran tensions. Pretty much every government worldwide, in the face of higher oil prices, dished out subsidies. I mean, that's printing money, or that requires accommodation through printing money, and that's the path of least resistance. And the fact is that a lot of governments are copying the US Treasury playbook, beginning to fund at the short end of the market. There's an awful lot of bill issuance going on. Treasury Executive Besson has been very clever here, that he's starving the market of long duration and basically pumping everything into the short end. Now, that's all well and good. I mean, it solves the problem near term, but the fact is that this is monetization. Writ large, because who buys this debt is predominantly banks, and if banks buy government debt, they're printing money effectively. So it's not the Fed that's doing the QE, it's arguably the private sector, but it's being pushed in that direction by the Treasury. And it's not going to end well because, end GDP, in other words, nominal GDP is racing ahead, and that just looks way, way incompatible with what the bond market is currently pricing. And so it looks as if bond yields, could rise appreciably. And if you want a heads up on that, just look at what's happening in Japan. They're going down the same path, but they're, a couple of years ahead. Well, I think that the situation is getting worse, and I think you can see that both in terms of rising yields. So that's basically denting collateral. But the other thing, which is actually almost more important, is looking at the volatility of that collateral. In other words, the MOVE index. And the MOVE index is definitely trending higher. And I think we're going to see coming out of the QRA tomorrow, the detail of the announcement, basically what they're going to do in the bill market and how much Treasury buyback is going to be announced. And those are sort of two critical numbers, because it pretty much says whether the Treasury stroke Fed want to control volatility. And in other words, to sort of cut a long story short, whether they want to stop the yield curve steepening again. Now, I think my read of what Kevin Walsh was saying last week was that he wants the market to do the tightening for the Fed. In other words, read that as saying that he wants, or is prepared to allow, longer yields to rise a bit, a bit in inverted commas. But he's also envisioning that the curve will steepen, because what he also says in the same sentence, that he's basically going to allow reserves in the bank reserves to remain ample. So that means they're anchoring the front end of the curve. They're allowing the back end of the curve to rise. So my reading of what he was saying last Wednesday was that the Fed is banking on a steepening yield curve. And that's pretty much what we've been seeing. It's reversed the trend of the first 6-7 months of the year, which has been a very clear flattening of the curve. So I think this reversal is really what the Fed has been secretly planning, maybe. Right. It makes a lot of sense. I mean, basically what they've done is that, we don't know the true scale of this yet, but, if the Treasury has intervened, I mean, that's effectively putting liquidity into the markets, for sure. I think that's one factor. But the other thing is that, Kevin Walsh said that he reaffirmed this ample reserve environment. And that basically is saying there's a lot of money at the front end of the curve in the repo markets. And that's clearly what they're aiming at doing. If there's liquidity in the markets, that's good for stocks near term. May not be great for bonds. And I think what you've seen pretty much since last Tuesday is the stock market picking up and the bond market, drifting off. And that would be, I think, a pretty, decent interpretation of that move.
Global capital flows reveal that central bank liquidity cycles are nearing a critical turning point that will redefine overall market momentum, as sovereign bond refinancing timelines accelerate rapidly. Monetary authorities will inevitably inject fresh liquidity into banking systems, despite hawkish public rhetoric. Economic forecasts predict that this forced monetary expansion will ignite a powerful multi-year rally in physical commodities, monetary gold, and hard assets, while heavily suppressing fiat currency purchasing power worldwide. Traditional equities will likely experience unpredictable swings as expanding money supplies collide with weakening corporate earnings growth. Institutional investors must recognize that tracking central bank balance sheet expansion is the single most accurate indicator for predicting major asset class turnarounds. Allocating into tangible, inflation-resilient assets provides the ultimate protection against upcoming currency debasement and institutional policy shifts. Now, let's get back to the interview.
There's going to be, this is Morgan Stanley's estimate, and that's not Michael Pento's estimate. There's going to be over $500 billion, $570 billion in AI-related debt raised in 2026. Then we also have the national debt, that's $40 trillion, 123% of GDP. That amount of debt is 720% of our revenue. We've broken the government's balance sheet is broken, and it can't save us from the next recession. So you go think back to the last two big recessions. What was the debt to GDP ratio? The national debt to GDP, 60%. Now we're at 123%. So, it's easy to borrow trillions of dollars and have it monetized by the Fed when you don't have an inflation problem and your national debt to GDP 60%. But when it's 123%, it could lead to a very big problem in the bond market. Mm-hmm. That's why I say that this next recession, and the onus is on the perma bulls to tell us why we will never have another recession and why the business cycle has been repealed forever. It's not on me. I'm not a perma bull or perma bear. I'm a perma realist. So someone has to explain to me why the business cycle has been annulled, and the answer is it has not. We will have another one, and that is when annual deficits go to $6 trillion because the automatic stabilizers kick in. The last two recessions we saw deficits rise threefold. Not they didn't double, they rose threefold. So doing the same math, we're going from $2 trillion deficits. By the way, those $2 trillion deficits that we have, the interest that we pay on our national debt is $24 billion a week. We're paying over $1.2 trillion just in interest. Adam, these are in the good times. So just imagine what happens when we have a recession and you have the unemployment insurance and the SNAP programs and the degradation of tax revenue come in. So we're going to have deficits just blow out immensely. And what does Warsh do? Does he monetize them too? I guess he has to. He has no choice. But so you look at the last two recessions, even though Mr. Bernanke and Mr. Powell monetized those recession away, we still had years where the market didn't reach a new high. 5 years to be precise in the 2007 crisis, where the market dropped 50% and then took 5 years to regain. And I'm going to go through some math too, if you want to, about prior lost decades.
Sure.
But it's very important for me and my clients to make sure that we are unscathed from the next recession, the next credit crisis, because it's going to be another lost decade or perhaps longer before we get back to even. My belief is, and again, I don't invest for what could or should happen a year from now. You can't be that way. You can't. Gold is someday going to go $10,000 an ounce, but there's sometimes I don't have any of it, and sometimes I have 20% of it. To think about inflation going, higher than it's ever been before, higher than 20%, and thinking about the unemployment rate going well into double digits, and the central bank is going to have to react to save banks that are failing left and right. I don't see them doing anything else because we're that far into it right now.
Yeah,
we've so over financialized the economy. The Federal Reserve started out as an institution that was the lender of last resort, and then and somehow over the decades it morphed into something that said we need to have a dual mandate, which is full employment and stable prices, and then stable prices became 2%. And then it became this. This is the real dual mandate of the Federal Reserve. Thou shalt never have a recession, and thou shalt never have an uptick in the unemployment rate, and thou shalt never have a bear market or even a pothole or a sinkhole in stock prices. That's the new mandate. That's how the fiscal and monetary authorities are now behaving. I have a lot of faith, confidence, and hope in my Lord and Savior, first of all, but also in Kevin Warsh. Kevin Warsh, if he lives up to his billing and he knows better, I firmly believe he's going to attempt a reduction in the Fed's balance sheet. And when you look at asset prices as distorted as they are, you need a constant infusion, a massive infusion of bank credit and money supply growth to keep them from popping. So any kind of diminution in the supply of credit to banks, any kind at all, usually manifests itself very quickly in the money markets, quickly.
Yeah.
And they freeze. And without the ability to the repo market functioning and commercial paper being floated, unless that's working well, it's over for the stock market and the real estate market. All well and good intentions going to try to shrink that balance sheet. I'm not aware if he's aware of the ramifications of doing so in history. It doesn't work too well. And it's not going to get any easier from where it is right now. So maybe it lasts for a few months. The repo market freezes, commercial paper freezes, and that's when, all heck breaks. You'll see spikes in borrowing costs. The discount, banks will be borrowing like crazy from the standing repo facility, and the stock market will tank as interest rates rise. That's how it usually works in the past. I have no reason to believe it'll be any different this time. I have reason to believe it'll be worse, given the levels that we're at.
Macroeconomic trends indicate that passive investing strategies will face severe headwinds as structural inflation and volatile bond yields reshape institutional capital allocation. Capital markets are entering an era defined by fiscal dominance, where massive government deficits will permanently elevate systemic risk premiums. Analytical projections demonstrate that institutional capital will rapidly rotate out of long-duration paper assets and unhedged fixed-income instruments into cash-flowing infrastructure, energy sectors, and physical wealth reserves. Over the next 18 to 24 months, central monetary institutions are forecasted to quietly deploy yield curve control measures to prevent government debt yields from breaching critical limits. This institutional intervention will create stealth monetary expansion, eroding the real value of cash holdings while boosting tangible asset valuations. To preserve wealth, market participants must shift away from standard index tracking and adopt active risk management, tactical diversification, and defensive liquidity buffers before broad market realignments take effect. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.